This is the wrap up for the live market open of Wednesday, December 16th. It's Fed Day, the big day is here. Our wrap up is mostly dedicated to a preview of the Fed, which is a huge event. Okay, let's quickly talk about what happened so far. Stronger dollar just because of repositioning. UK inflation as expected. German ZU as just a bit above expectations. US inflation is okay, 2% on the core, good enough for a hike. Empire State okay. Manufacturing sales in Canada disappoint, and milk prices rise again, help the Kiwi stand out against other currencies. Okay, today we have a busy agenda ahead of the Fed, even though the Fed will somehow overshadow it. So we have UK employment data. Most important figure to watch there is year-over-year average hourly earnings. Wages expected to fall from 3 to 2.5%. If a smaller fall will be positive for the pound. Eurozone final inflation data not expected to move the needle because it's old data. Building permits, housing starts, industrial output, all from the US, all of importance, but less so today. They'll all need to move in the same direction, either positive or negative, to impact the US dollar. For those trading the loonie, crude oil inventories are to watch, and of course the Fed decision at 7 GMT. So the Fed is releasing its decision at 7. Rate hike is widely expected. Join us for the broadcast. We'll begin a few minutes before that. I think it's not fully priced in, and if it is fully priced in, also a gradual move is priced in. The message we've received from the Fed in recent months is we're going to hike in December, and afterwards we're going to move slowly. If the Fed, for any kind of reason, does not hike, it'll lead to a crash, a total collapse of the US dollar and the credibility of the Fed. Highly unlikely. The Fed is almost certainly hike, even if at this moment they regret it because they prepared everybody for this. Okay? The messages in the statement to watch are what they view the US economy, how gradual they put it in words, and they'll say, of course, data dependent. But apart from words, they're releasing the famous dot plot. Most important in the dot plot is the path of rate hikes, okay? And the median one, the snapshot, the bottom line, okay? In September, these were the numbers: 1.4 median expected interest rate in the United States at the end of 2016, 2.6 in 2017, and 3.5% in the longer run. These were lowered from the previous one. Now they're expected to drop. Dropping will be the dovish hike we're all talking about, the message that we're doing this liftoff, raising rates, moving away from zero, trying to prevent bubbles. The US economy is doing well, showing confidence. And having said all that, don't worry, we're standing by your side, the side of Wall Street, if you wish, the side of Main Street. That's open to political discussions, and we'll move rates slowly. So I believe that a small drop in expectations from, let's look at the dot plot, from 1.4, let's say in 2016, to 1.1 is the dovish hike that is priced in, that is expected, will not hurt the dollar too much, okay? And below that, below 1%, let's say, for 2016, will be very dovish. If they don't move the dot plot, if they don't move the median for the federal funds rate too much to the downside or not at all, this will be hawkish for the dollar, okay? So the statement, the tone of the statement, optimistic, pessimistic, dot plot, key events for the initial reaction. We also have the forecast growth is expected to be lower just a bit from 2.3, unemployment perhaps just a bit, and core inflation also just a bit. That's what the Fed usually does because employment is doing better than expected, inflation is stuck, and growth is also in with the middle mediocre land. Okay, and then the press conference by Janet Yellen at 7:30 GMT. Main messages: gradual, data dependent, and haven't taken decisions for 2016. So it's not a one and done. One and done will kill the US dollar because, and if it's one and done, why is the Fed moving at all? but they could be more sort of course, gradual. We're going to move very, very slowly. She will not say when, because that will be data dependent, but she will probably repeat this message. My personal scenario for the Fed is that we'll have perhaps a stronger dot plot than expected. That means the path of rate hikes will remain mostly untouched or just a bit lower. This could strengthen the dollar initially, and then Yellen will be a bit more cautious, a bit more dovish, and that could weaken the dollar. But that all in all, in the morning after, we'll have a stronger dollar, and the real weakening of the dollar will begin only somewhere in Q1 after the holidays. Okay, and that's my personal scenario. The Fed decision reaction in currencies. It depends on the message. If the Fed is saying the US economy is doing well, we're doing a liftoff, employment is good, inflation will rise afterwards, we're confident, confidence, good for the United States, good for the global economy, good for risk currencies, for commodity currencies. Strongest is the Kiwi, then the Aussie, then CAD. If they have a worried message, okay, the US economy is doing better, we need to get out of zero, but we're worried about the strong dollar, worried about China, worried about Europe, worried about deflation, things like that. Stronger safe haven currencies, the yen first and foremost, and the euro. Remember, there are many reactions. The statement, the dot plot, the press conference, and then a second reaction in Tokyo, a full reaction the morning after, and the echoes of this decision will be heard for weeks. Once again, I repeat, we're close to Christmas. Liquidity is a bit lower. That means movements can be exaggerated. I don't think we'll have the same range like with the ECB, but if the message is one-sided, all hawkish or all dovish, we could also see that kind of reaction. In any case, the level of choppiness that I expect is high, so trade with lots and lots of care. Okay, so that's a long wrap up for today with a long preview because it's really, really a big day for the Fed. Let's see if we have more questions before saying goodbye.